The fate of the housing market depends heavily on what the Federal Reserve does for interest rates, and this week the Fed shocked markets with a higher than expected increase to their Fed funds rate. In today's video, we're going to look at what the Fed did and what Fed Chairman Powell said at his press conference this week, and what all this means for the housing market. Let's get into it. This week, the Federal Reserve announced a higher than expected 75 basis point increase to their Fed funds rate due to a higher than expected inflation reading in last week's CPI report, as well as weaker than expected job numbers in the government report at the beginning of June. Speculation of the Fed's move to raise their federal funds rate by 75 basis points came in just this week, shortly before the Fed started their two-day meeting. Before that, it was widely expected they would raise rates by 50 basis points. Powell himself had even said after their last rate hike of 50 basis points in May that they were not actively considering a 75 basis point increase. But now we have the 75 basis point increase. It's on the books. The Fed keeps upping the ante and getting more aggressive with each meeting as the inflation data just isn't going the way they want it to. The CPI reading for May was the highest in 4 decades, surpassing the peak set in March. There may come a time when the Fed will need to get as aggressive as they did in the 1980s, the last time they had to deal with record levels of inflation. Back then, they had to raise the Fed funds rate higher than the rate of inflation to bring it down. With the latest increase, that puts the Fed funds rate at 1.5%. It's the highest it's been in years, but given that consumer inflation is running at 8.6%, they're going to have to get really aggressive in the months to come if they want to truly tame this inflation beast. Powell indicated that there could be another 75 basis point increase in their July meeting, but if we see another hot inflation report next month, I wouldn't be surprised if they kicked it up to 100 basis points. But for now, we're looking at a 75 basis point increase in July. So what the Fed has done here is pretty much in line with what is in my second housing crash scenario, that the Federal Reserve will raise interest rates by 75 basis points at each of their remaining meetings this year. Under that scenario, mortgage rates are expected to reach around 6.4% by the end of the year. Such a rise in mortgage rates would lead to a deterioration in housing affordability, and home prices could fall by upwards of around 18% in response. Now, I call that more of a correction than a crash, and right now it is looking like the best case scenario for the housing market. In the next few weeks, I'll be releasing an update to my housing crash scenarios with all the data that has come in this month, and I'll be looking at which scenarios could lead to a decline of up to 30%, which is what I call a crash in housing prices. If you want to stay up to date on all the developments impacting the direction of the housing market, make sure you're subscribed and hit that notification bell down below so you know right away when my next video comes out. And if you've enjoyed this video, please give it a thumbs up and share it on social media to support the channel and help it grow. It is greatly appreciated. Thanks for stopping by. I'll see you in the next video.